Welcome, everybody. This is Steve Tileman here with Trade the Pool, and we're going to be talking about some intermediate gamma trading today. We're going to be building upon our last installment there, where we went into the basics, the fundamentals of gamma exposure profiles, and what the various levels mean. So we're going to give a quick refresher there, and then get into some really good actionable strategies using these techniques. So, yeah, like I said, we're going to give a start with the foundations. We're going to be talking about basically what GEX profiles are very briefly. We're going to be talking about the key levels, that zero gamma level, your max gamma strikes, and just how to read the profiles in general. Then we're going to get into, like I said, 5 high probability trading setups. These are going to be really good because they're going to take these kind of more abstract concepts when you're first learning them and turning them into actionable strategies that you can employ just about every day. So those 5 strategies are going to be 2 based on the zero gamma level. We're going to be talking about how to play a bounce and how to play a breakdown. We're going to be getting into some mean reversion strategies in terms of a drift up to the max strike or the call or put wall, as well as an expiration day pin strategy that we actually saw and used on Friday. So after that, we're going to get into one more, and that's going to be the gamma wall bounce. And it'll be just, another really reliable tool that you can add into your toolbox here. So first off, let's get started with what gamma exposure is. Gamma exposure is the hedging pressure that option dealers must execute. And this is going to be leading to some very predictable flows that we can use to predict intraday price action and also intra-week price action as well. So to get into a little more granularity there, when there is a large call expiry, for example, that means that dealers are short a lot of calls because they have sold a lot of calls to speculators, whether they're institutions or retail, doesn't really matter. They're people who are speculating on the market movement. They have a directional bias. Market makers, by definition, have no directional bias. Their job is to stay delta neutral and basically hedge their exposure. So they don't want to make money. They don't make money when price goes up or down. They just make money in terms of the amount of transactions they make. Their job is to stay flat. So when they sell a bunch of calls, they have to protect themselves if the price goes up. That means that they have to buy the underlying mechanically. They have to buy SPY, for example, mechanically when there is a lot of call strikes above it. I hope that kind of makes sense. So what we talked about last time was that there were 2 main regimes. So there's the positive gamma regime and the negative gamma regime. When you're in a positive gamma regime, then you're going to be in a very supportive market structure. You're going to be in one where dealers buy the dips and sell the rips, and this stabilizes the price. So you can think about this as like in a bowling alley, the bumper rails are on up on the side. You can't go in the gutter, or you have to really try hard to get it in that gutter, because there's going to be a natural mechanism, which is mean reverting price. If it goes too far to one side or the other, there's going to be pressure that's dampening that movement. So this leads to a buy the dip mentality, because essentially when there's a big level up above, price is going to gravitate up to it, that magnetic pin, pull back a little bit, and then get bought by the dealers as it's being sold, and slowly whittle away, eat away at that level until it's ready to break through or reject. So this leads to, in general, range bound and low volatility price action. And when you do break the range, like I was just saying, it takes some time to develop. And price is going to be attracted to that max strike. So you can get some really reliable setups that we're going to get into. When you're talking about negative gamma, that's when price is trading under that zero gamma level. And the moves are going to be amplified, essentially. So in the positive gamma regime, like we were talking about, the moves are dampened by market maker activity. In a negative gamma regime, however, they actually have to sell into weakness and buy into strength, which leads to oversized moves in both directions in that really choppy, mean expansion pattern, stop running type behavior that you associate with, those kind of BS days in the market. Well, often the reason behind that is because we're in negative gamma. So when you approach a level to the downside, dealers are selling into the weakness, and you blow right through the level and then whip back up and reclaim it equally as violently. So you can get those V-shaped reversals. You can also just get the bottom just straight falling out through levels too. And so if you are able to predict this or to know in advance, if and when, a certain level breaks, we're in this negative gamma regime, then you can tailor your trading plans accordingly. And it's a very, very valuable thing to know. All right, so that is the basic overview of what gamma exposure is and why we care. And that goes over what we talked about last week. So now you guys are all caught up and we're ready to get into some new stuff here. Oh, I lied. One more screenshot. Here we go. Okay, so this is just going over the most essential parts of a gamma exposure profile. The most important level is that 0 gamma level we talked about. And that's because, like we just said, it's very important to know whether we're in a positive or negative gamma regime there. And that's the level that decides it. So that's really the most essential that you need to know, all the basics you need to know. So let's get into our first setup here. This is the 0 gamma bounce, and it's a long setup. And so here are the entry conditions. We're going to be looking for the price to be in that positive gamma regime. We're going to be looking for price to touch or slightly break below that 0 gamma. And then we're going to look for it to reclaim on a close of a 5-minute candle. And we also want to see a nice volume spike into that level. So this is going to tell us a few things. It's going to tell us that, okay, we are coming back to this magnet and we want to see whether or not there are going to be significant buyers supporting this and moving us back up into the range. As long as we hold the 0 gamma level, we stay in this buy the dip zone or buy the dip regime. So the volume spike in particular into this level is going to indicate that sellers have exhausted themselves just getting to this level and they don't have the juice to punch through. We wait about 5 minutes. This can depend on your strategy. If you're a really short-term scalper, maybe you're looking for a 1-minute confirmation and you're taking just the first move up. That's valid too. But if you're looking for one of these slightly bigger day trades, looking for, let's call it 5 to 20 points on ES, something like that, a few dollars on SPY, you're going to be looking for a 5-minute confirmation of that candle. And that just gives you the kind of confidence to know that it isn't just a very, very short-term first touch response to the level and that there's actually going to be a significant push. So the entry, you can use a market order just to get in right when we're getting into that, the close of that last candle there. So on our chart here, you see this 5-minute candlestick, the first green one there. When it closes, you can just enter right there on the close just to make sure you get in because you're probably going to get a pretty fast expansion. You can also use a limit buy order above the current price. So for example, you can have once this candle closes, you can put a limit buy order when it breaks above the top of the candle. And so then your thinking is, you might be thinking, why would I only want to buy it if it's at a higher price? Well, the idea is if it gets this surge, it's very likely, if it gets the microstructure break of breaking the previous 5-minute candle top, this wick right here, there's a very good chance because of the buy level we just interacted with that you get a nice clean push up. And if we don't get that break, it maybe takes a little bit more time and it could even just pop down here a few more times and break down. So the idea is you only want to be in the trade if it does get that surge up. And when it does, you want to be in right when that surge starts. So this is one of those situations where you can use a limit buy above your price. So your target is going to be the maximum strike, which today was the 680. So that would have been the nice target. But since we had already swept it today, it makes sense that we kind of stalled out above that. So you can't be too greedy or too set on retesting a previous level because we got to look at these as pools of liquidity that are a finite resource. And by that, I mean, when we dip up here, we take a lot of the liquidity here. And it means that we might not have to revisit this for some time. So the path of least resistance was up to collect this liquidity, then down to retest 0 gamma, and then up again, but maybe not necessarily up here yet. Like we could see it needed to consolidate more. So remember, don't get too greedy, but you can get a really nice scalp. Like for me, for example, today on this day, I took it to VWAP and I was happy with that. And that's another part. It's just learning when to be happy with when enough is enough. So off of these 0 gamma levels, often that will be the case because essentially you're just looking for that first transaction of the liquidity on the back test. So you don't necessarily want to take this a second or third time, but it's this first retest, this first bounce, and then you're just kind of gauging the strength of the market by how much of a bounce you get off of that. All right, and your stop loss is going to be a 5-minute close below the 0 gamma line. So if we lost this wick of this 5-minute candle right there, I wouldn't want to be in it anymore. Just wouldn't be a trade I'm interested in anymore. I would be looking for it to consolidate, and then I would be interested in playing a 0 gamma breakdown, which is what we're going to talk about next. So here's the 0 gamma breakdown setup. And by the way, all these examples on SPY right here, they were taken from my own trades in the past like week or two here. So these you get these setups a lot. You just got to know what to look for. So for the breakdown setup, here's what we're going to be looking for. We want price to break and close below the 0 gamma level. That's very key. So first off, let's frame the chart here. See the 0 gamma level? It's right in the middle. We can see that on the previous day's price action, price was kind of oscillating around this level as a pivot as well. That's a big part of why it was the 0 gamma level going into the price, or going into this day's price action. In the morning, we see a strong incentive to sell already. We had already swept liquidity from this close, the swing high into the close the previous day, and it opened, it tried to push higher, and then there was instant selling response. So we're already pretty darn bearish going into this. And we see price immediately come down to the 0 gamma level as we would expect. It fills this gap here. That was when I trimmed my short, just a nice little scalp to fill this because I was not sure we would get this big breakdown. So when we get the consolidation, we can see that price is failing every time it comes into this ribbon here. And this is all just building our bias here for a breakdown of this key level. So now we look for our entry here. The entry is going to be essentially when price breaks and closes below the gamma level, this blue level right there. We want volume confirmation, at least 20% above average. So this is where a moving average on your volume, this blue line down here, is very helpful. We can see on the break, that's that first jump in the volume there. See how the volume consolidates right into the breakdown? And then you see the volume spike above average. And this is about 30%, maybe 40% above the moving average. So you get that nice above average volume spike down, and you get just the candle that closes all the way down there. So that's when you know things are picking up, and you can get an entry right at the close of that candle, or you can wait for the open of this candle to fail to push up and break through. Either way, you get the nice just fall down. And where is our target? It's going to be the next notable level down, and that is usually going to be the next gamma wall. So the put wall. And today, or on this day, it was 674. And there was also some at 675 as well. So it was kind of like a like a $1 zone in between those two strikes there. As we can see, that is where the tape began to be mixed, and we saw buyers trying to participate again after this free fall. And this was another little straight shot trade here. And sure, it did go down further at the end, but that's less predictable. What was predictable is that when it failed 0 gamma, it would go down to the next node of interest. I also put or minus 1% from entry, because often if you do get a 1% move from a key level, like a 0 gamma level, you will see an almost like plunge protection type effect happening, where there will be a lot of vol sellers stepping into the market to stabilize things, even if we are in a negative gamma regime, just at these breakpoints. And they don't always succeed, but usually if we're down 1% on the day, we're already oversold, and this is enough to kind of stabilize things. So that's a nice round number to also just look to lock in profit if you're an index trader particularly. So the stop loss is going to be the reclaim of 0 gamma, because if this expansion candle down, for example, couldn't breach this low or breached it and then closed above here, then we could be looking at a potential change of character, a potential big buyer stepping in to hold this 0 gamma level. But in general, when you have poor structure like this, it's poor for a reason, and it wouldn't be so heavy into the 0 gamma level if it wasn't going to break down. And just to compare, we'll go back to this one where we bounced. See the immediate response. So if you're going to do a gamma bounce, this is what you want to see. That really sharp response showing, hey, we're still here. We're still ready to party, and there's room up now because of this push down. And this consolidation did break out to the upside the next day. So here, like we said, much weaker, and we get the flush. So that 0 gamma is your anchor. You got to know where it is, because it's going to really inform your trading. All right, now we are getting into level 2 here. And this is going to be stuff revolving around the maximum strike, or the gamma pin. This is also referred to as the call wall or put wall, depending on which side it's on. And essentially, it's going to be the strike price with the most open interest. And so dealers have the maximum short exposure there, short call exposure, assuming that their calls, and price will magnetically be attracted to there, especially near the expiration. And the closer we are to it, the more of a self fulfilling prophecy it is. If the strike has high open interest, but then we move very far away from it, maybe off of a news based catalyst, some kind of tail event, then as we get further and further away, those strikes become less and less relevant in terms of their magnetic pull, because they essentially, they become less and less likely to come into play, and they become less and less needed to be hedged by market makers. Does that make sense? So, based off of that, we have some more setups that we can talk about. The first is going to be the drift to the max strike. And so, what this is going to be like is essentially we are going to be betting on, usually this will be after a big down day. If the big strike is still on the tape from, above, for example, Thursday into Friday, there was so much gamma exposure at the 680 strike, but we were trading down at 674. Well, the mean reversion occurred on the Friday where we saw just a gradual drift up all day long to this key 680 strike. And that's where sellers finally stepped in. So here are the entry conditions. The price, we're looking for basically a decent distance away from this max gamma strike, but still like reasonable. So it's not like too far away, so where it's not relevant, like we were talking about. So usually 0.5% to 2% away on the indices, depending on, 2%, that's pretty extreme for SPY, but not so crazy on IWM or even QQQ. So, somewhere in that kind of zone, we're going to be looking for a positive gamma environment. So, for example, I didn't take this trade out of the gated open. I waited until we stabilized above zero gamma here. So once we were stabilized above the zero gamma, we were in that positive gamma environment where the low volatility should just cause the drift up to take place, and it'd be a nice stress-free trade. So I would have made more just longing the open, but it would have been a higher stress trade, because what if I long the open and we reject just a little bit higher at zero gamma, $1 higher? Like, I can take that scalp, but I can't really stick in that for a high conviction play until we get this flip of this level. So this usually occurs about 15 minutes to half an hour into the session at the earliest. So you don't want to jump on a trend super fast, because it might be a reversal in the first 20 minutes or so, half an hour. So usually this stabilization will occur after that over the zero gamma strike, like we're talking about. And so this was where I entered here. As we were stabilizing, we popped it, we came back, found buyers, came up, and we were just consolidating near the top of this new consolidation range. That's very bullish to me, because in my mind, we're just waiting for these moving averages that just exploded up to kind of catch up, and then they should be our support, which we see throughout the day up to our target at 680. So a very stress-free trade. We love trades like that. So the entry, like I said, when price stabilizes after the move away from the max strike. So the previous day we had the move away from this max strike, then price came up above zero gamma and stabilized. So not a huge move on this. You could have also played the mean reversion, and been a little riskier and longed the previous day, before the close. But in terms of the easy money scalp, from right here to right here. And let's see. The target, like I said, that maximum strike plus or minus 0.2%. And basically that's just saying it could overrun it a little bit. It could fail to get to it, just get close. So don't be super hard set on getting the exact, strike fill, because maybe it might stall out a little bit earlier. For example, right here, we were considering having to cut the trade if it did not catch at our moving averages, but it did. And then this was the big wick where I was like, okay, that's probably enough. That's probably like the big squeeze over the level, and now it's going to need to cool off. And it did. It did go higher later in the day. So, it's always an art to this, right? It's never an exact science, but for the easy money trade, went up here and then came down a little bit before going back up. All right, on to setup number 4. And this is a fun one that we only get a few times a month. And, well, I guess there are smaller expiries, but for this big OPEX like we had, we don't get them very often. And essentially the setup is this. We want to, in the morning, see price away from the max strike, and we want the same positive gamma environment, and we want the same low volume environment. And this is just going to be typical for these kind of pin moves. And essentially the play is that if we are away from the max strike into the last couple hours of the day, we can bank on price trying to mean revert back down to that pin level. So, for example, this was Friday here, and essentially the setup is that we kept drifting higher. Remember, I said we stalled out at 680, but then went a little bit higher. So here we did reach 681 a couple times over the day. So 681 here, we formed a nice double top, and the setup here was saying, okay, sure, we do have a lot of time left in the day. This was at 10:15 my time, so 1:15 market time. The setup essentially is we're over 680. We think price is going to try to close or at least retest 680 by the close. So it's a pretty safe setup to say that, hey, if we see any kind of selling patterns up here, probably they play out at least a little bit, right? Back to that 680 level. So we got a nice double top and we see a failure of the moving averages. I took a little scalp here and I forget exactly where. I probably took it off under this level right there. But maybe I was holding for the 680, and when I saw we didn't get it, I might have got stopped out here. I kind of forget. I do remember this was the trade that I took before I did my appearance on Trader TV, and it was the same kind of thesis, but with higher conviction, because this time we had made a higher high, just a little bit of a sign of strength. I would have preferred to see a lower high. This time, however, we made a lower high compared to this push up, and also we made a lower high in the smaller structure here. And it looked like this was algorithmic buying that kind of turned off as we approached this OPEX exposure, and the contracts that were expiring that day started to be basically unwound, the hedging. So this was the setup to just short right to this 680 level. And as you can see, we got a pretty aggressive sell-off. It did take a while, but once it was ready, it just puked. And then we knew where we were getting out. 680 we trimmed, and then just you have the VWAP and the 50% of the range right under that. So whenever you have that confluence right near your target, we took the rest off there. So it was a really nice little trade. And I think we took a fun little scalp long too. But essentially, this was all very, very likely to happen just based on these gamma exposure profiles that we were looking at, and especially just the size of this 680 pin. So just one more little thing that you can look for every couple times a month, you get a very high probability setup. Now we're going to get on to the last level for today, and this is going to be gamma wall trading. So gamma walls are going to be the hardest to break. They're going to comprise of the most gamma concentration of calls or puts, and they're going to act as strong support if it's a put wall and strong resistance if it's a call wall. So they're going to definitely require significant strength and by extension volume to break through. And we have some setups that we can take off of these. Because of the strength that's needed to break through them, we are going to be looking to play the bounces off the long. Oh yeah, and this is the same setup where if you are waiting for 680, you could play that bounce long. We just took a little scalp, but I think the swing is going to work too. So price is going to approach that large gamma wall, that 680, this big blue level. And the first test of the wall is going to be where we want to get involved. See this first test here? We don't really want to wait until the third or fourth attempt because, like I said earlier, this is like a finite resource. It's like a pool that we're dipping into, and we want to see when we expend this resource, we want to see a strong reaction. And the next time we go down there, there will be less of that same resource to push us up. So always better to play the first bounce off of these. And you are waiting for a rejection candle off of this level. So basically a failed auction down. So that's what I would describe as this big push down that closed higher and then, essentially closed up here. And this would be another one, this big green here. So ideally, this would be the one where you start looking for an entry and you start building a position in here. And this would be a little scary, but once it shakes you out for 10 seconds, or hopefully it doesn't shake you out, but once it scares you for 10 seconds, then you're off to the races. So that is the rejection candle, and you see the nice big spike of volume start right there. Very good sign. And then you're going to be putting that market order or that limit buy order on the rejection close or above the rejection close if it's the limit buy. And your stop is going to be a clean break through the wall. So for example, if this candle that ended up resolving big green This, if this plunge down, closed down here or down here, then you'd got to say, hey, this initial candle, this was where the buyer stepped in. If this buyer fails, then I don't know where we're going, down to find a new buyer. And so that's it's not a situation that you want to be trapped in. So that's going to definitely be where you define the risk. So those are the 5 setups we have for you today. Next week, we're going to be talking about things just in a little bit more detail. We're going to get into some more advanced concepts and how to kind of layer these concepts together to kind of flesh out your understanding of gamma exposure profile trading as a whole. So we're going to be talking about intraday regime changes, essentially how to adapt when gamma flips mid-session, because that's super key. And that can be an area where a lot of traders can really get blown up on these days where you think you're in one regime and then you flip and you can't adapt fast enough. And all of a sudden you're in buy the dip mode still, but the market sure isn't. So very important to identify that. We're going to be going over multi-time frame GEX. So combining daily and weekly gamma for a better edge. By combining these two, we kind of get a how would I put it? You can kind of see the market almost in like 3D, if that makes sense, because you have the projections for where it's going in a day, but also in a week. And kind of the interplay between these can get you really nice setups. For example, a short that you see playing out intraday might end up being a long for the intra-week setup that you're looking for the real bank. So you can take a little bit short, but you're really looking for that long based on the weekly gamma profile, something like that. So then we're also going to go more into risk management by regime, basically how to ebb and flow with the market conditions so that you're not overexposed in a dangerous situation and you are putting your money to work as best as possible when situations are good. We're going to be going into some zero DTE trading expiration, zero DTE trading strategies as well. We don't do options at Trade the Pool, but just because we are talking GEX, there are one or two that we can talk about. And the most important thing to remember, though, is that all of this is not specifically for options trading. It is using options data to inform your directional trading for intraday trading. So this is for all scalpers, not just options traders at all. So guys, that's what I got for you today here for GEX profiles. I hope you enjoyed something. I hope you enjoyed all of it. I hope you learned something. And I look forward to bringing you more in 2 weeks. Be sure to tune in next Friday, where we're going to be doing our usual trading recap. And we're actually going to be doing a little bit of a special one for the holidays as well. We're going to be doing our best and worst trades of the year, recapping the year as a whole. And I'm going to be taking some viewer comments too, like what are your best or worst trades? We'll see if you make the nice list or the naughty list. And it'll be a good time. So definitely tune in next Friday. That will be the day after Christmas. And then the following Friday, we will be back for part 3 of this gamma exposure series. Thanks so much, guys. I'm Steve Tileman here with Trade the Pool, and take care. Have a great day.